Somewhere out there today, two people are opening their first investment accounts. They're the exact same age, make the exact same salary, and have the exact same $400 left over at the end of the month. One of them is going to spend the next 6 months stressing over the perfect stock, watching crash predictions on YouTube, and waiting for the perfect moment to get in. The other one is going to buy the most boring fund in existence, set up an automatic transfer, and completely forget the app even exists. Fast forward 30 years, the boring investor retires with over $1 million. The smart one, the one who read all the news and tried to time the market, ends up with less than half of that. Same money, same market, same 30 years. Why? Because one of them barely participated in their own portfolio. And today, we're talking about getting out of your own way. If you've ever stared at an investing app for 20 minutes, felt overwhelmed, and closed it because you had no idea what button to press, you are in the right place. Grab a coffee because by the end of this video, you'll know exactly what to do with your money in 2026, in what order, and why. But before we touch a single dollar, we need to have an honest conversation about the year you've chosen to start. 2026 is not a normal year. The American stock market just had incredible back-to-back-to-back runs. The S&P 500 has been soaring, which sounds great, but it means stocks are currently trading at some of the most expensive valuations in recorded history. Right now, the market is incredibly top-heavy. Just 7 massive tech companies make up roughly a third of the entire S&P 500. Because of this, huge institutions like Vanguard are projecting lower than average returns over the next decade. So you might be thinking, cool, great pep talk. I'll just wait for the market to crash before I buy in. If that's what you're thinking, I hate to break it to you, but that perfectly human instinct is the single most expensive mistake in investing. Back in 2012, people said the market was overvalued. They waited for a crash that never came, and they missed out on massive, historic gains. The data is clear. Over every 20-year period in American market history, including the Great Depression, the 2008 financial crisis, and the 2020 pandemic, the S&P 500 has never lost money when adjusted for inflation and dividends. The market punishes impatience, and it absolutely rewards stubbornness. Expensive markets don't mean you wait. They mean you stop gambling and you start using a boring, diversified, low-cost plan. Let's get into it. Before I tell you how to invest, you need to understand why we're doing this. Because if you don't, you will panic and quit the first time the market drops 20%. If your money is sitting in a standard checking account, it is slowly dying. In early 2026, inflation is still eating away at your purchasing power. Meanwhile, your traditional bank is paying you pennies in interest. Leaving your money in cash isn't saving, it's paying a storage fee for the privilege of getting poorer. Now, compare that to investing. Historically, the U.S. stock market returns about 10% per year on average, or roughly 7% after inflation. The magic isn't in any single year. The magic is in compounding. Say you invest $1,000 and it grows 10%. You now have $1,100. Next year, you aren't earning 10% on your original $1,000. You're earning it on $1,100. Then on $1,210. The growth itself starts growing. Leave that single $1,000 alone for 30 years at 10%, and it turns into over $17,000, and you literally did nothing. The money did the work. But here's the secret nobody tells beginners. Compounding feels like a scam for the first decade. Charlie Munger famously said the first $100,000 is the hardest. If you invest $500 a month, it takes about 11 years to hit your first 100K. But the next 100K takes just 6 years. The one after that, 4 years. Eventually, your money makes more money than you actually contribute. Early on, you're the one working hard. Later on, your money does the heavy lifting and you get to be the freeloader. You just have to survive long enough to reach the freeloading phase. All right, you're sold. You want to invest. But where do you put the money? A huge mistake beginners make is thinking an account is an investment. It's not. Accounts like a 401k or IRA are just buckets. You put your investments inside these buckets, and the government taxes these buckets very differently. Here is the exact order of operations you should follow in 2026. Step 1. The 401k match. If your employer offers a 401k match, this is non-negotiable. If they match 50 cents on every dollar you contribute up to a certain percentage, that is an immediate guaranteed 50% return on your money. Nowhere else in finance does that exist. Put in enough to get the full match. Do not leave free money on the table. Step 2. Destroy high-interest debt. If you have a credit card charging you 22% interest, paying that off is mathematically identical to finding a guaranteed, tax-free, zero-risk investment that pays you 22%. Even Warren Buffett doesn't average 22% a year. Pay off any debt with an interest rate over 7% before you do any serious investing. Step 3. The emergency fund. Save 3 to 6 months of essential living expenses and put it in a high-yield savings account. Why do we care about savings in an investing video? Because your emergency fund is armor for your portfolio. Market crashes love to happen at the exact same time you lose your job or your car breaks down. If you don't have cash, you'll be forced to sell your investments at a massive loss. The emergency fund gives you the superpower of doing absolutely nothing when the market panics. Step 4. The HSA, a health savings account. If you have a high-deductible health plan, the HSA is a secret weapon. It is triple tax-advantaged. The money goes in tax-free, grows tax-free, and comes out tax-free for medical expenses. Pro tip: treat it like a retirement account. Pay small medical bills out of pocket, let the HSA compound for decades, and cash it out later in life. Step 5. The Roth IRA. You can open this yourself in 10 minutes at Fidelity, Vanguard, or Schwab. You fund it with money you've already paid taxes on. It grows for decades, and when you pull it out in retirement, every single penny of growth is completely tax-free. If you are young and in a lower tax bracket right now, the Roth IRA is the deal of a lifetime. Steps 6 and 7. Max out the 401k, then a taxable brokerage. Once your Roth is maxed, go back and add more to your 401k if you can. If you fill that up, everything else goes into a standard taxable brokerage account. Okay, the buckets are built. What do we actually put inside them? Wall Street spends billions of dollars trying to convince you that this part is complicated. It's actually insultingly simple. First, let's talk about what we do not buy: individual stocks. A massive study analyzed every U.S. stock since 1926. Do you know what they found? The majority of stocks over their lifetime performed worse than a basic, risk-free government savings bond. Just 4% of companies accounted for all the wealth the stock market has ever created. Stock picking isn't finding good companies. It's trying to find a needle in a haystack where most of the hay is actively losing you money. What about paying a professional fund manager? Statistically, over a 15 to 20-year period, over 90% of highly paid active fund managers lose to a basic market index. This brings us to the hero of the story, the index fund. Instead of trying to find the needle, you just buy the entire haystack. An index fund like VTI, Vanguard's Total Stock Market Fund, or VOO, the S&P 500, makes you a part owner of every major company in America. You will never beat the market, but you will also never lose to it. And by getting the market average, you will mathematically outperform 90% of Wall Street professionals over your lifetime. And the best part, the fees are basically zero. Funds like VTI charge 0.03% a year. Fidelity even has zero-fee index funds. Why do fees matter? Because a 1% fee on an actively managed fund doesn't sound like much, but compounded over 30 years, it will literally eat hundreds of thousands of dollars of your potential wealth. So what's the perfect 2026 portfolio? You can build a simple three-fund portfolio, roughly 60% in a total U.S. stock market fund, 30% in a total international fund, and maybe 10% in a total bond fund to stabilize your ride. But honestly, if you want to think about this for 0 minutes a year, just buy a target date index fund. You pick the fund with the year closest to when you turn 65. It automatically holds U.S. stocks, international stocks, and bonds. It automatically rebalances. It automatically gets safer as you get older. It is the ultimate set-it-and-forget-it machine. The minute you start doing this right, an entire industry of people will materialize to try and help you do it wrong. Keep an eye out for these 4 traps. Trap 1, the 1% financial advisor. Unless you have a wildly complex tax situation, an inheritance, or a business sale, you do not need to pay someone 1% of your entire net worth every year to buy index funds you could buy on your phone in 10 minutes. If you need advice, hire a flat-fee fiduciary. Never pay a percentage of your assets forever. Trap 2, whole life insurance. Someone from your high school is going to message you to sell you whole life insurance, pitching it as an investment. It is a terrible investment with massive fees. Buy cheap term life insurance if you have dependents and invest the rest in index funds. Trap 3, robo-advisors. Apps like Betterment or Wealthfront are slick, but they charge you around 0.25% to do exactly what a target date fund does for a fraction of the cost. They aren't evil, but they are a training wheels tax. You don't need them. Trap 4, crypto. I don't know where Bitcoin is going next, and neither does anyone on Twitter, but if you want to buy it, do it only after your emergency fund is full, your debt is gone, and your Roth is funded. Cap it at 1 to 5% of your portfolio and treat it like casino money, not your retirement plan. We've covered the buckets, the funds, and the traps. Now I have one last crucial piece of advice for you. At some point, maybe this year, maybe in 5 years, you are going to open your brokerage app and see that your portfolio is down 30%. Because of how expensive the market is in 2026, it is highly likely you will experience a brutal market drop. This is not a risk, this is a scheduled event. Crashes are the entry fee you pay to get stock market returns. So I need you to commit to your crash protocol right now while you are calm, because you won't be calm when it happens. When the market crashes, you do nothing. Actually, you keep your automatic transfers running. Your paycheck will automatically buy shares at a massive discount that you will be bragging about a decade from now. You do not check the app daily. The red numbers are only real if you sell and lock in the loss. The people who get destroyed in stock market crashes aren't the ones who held on. They are the ones who panicked, sold at the bottom, and missed the legendary recovery days that followed. Starting to invest in a market that feels expensive or uncertain is scary, I get it. But there are no safe years. People felt scared in 2008, in 2012, and in 2020. The market is an incredibly efficient machine designed to transfer wealth from the people who wait for certainty to the people who act without it. You do not need to be a genius to build wealth in 2026. You just need an automated plan, boring index funds, and the stubbornness to outsit everyone who tries to get rich quick. If this video saved you from a 1% financial advisor, a bad life insurance pitch, or an emotional panic sell, please share it with one friend who keeps saying they need to start investing. Hit that subscribe button for more honest math about money, and I'll see you in the next one.